So the special items breaks down to, again, two parts. The parts that we sell out to others, discontinued operations, either just simply terminated it or sell it out, and the part that's considered extraordinary. Okay. So here's an example that we continue for $54,000, and let's say that we discontinue this segment of the business. Going back to that example, is we want to sell the hotel part of our business, and this year they still generated $35,000 of revenue. This is the part, the last year that it exists in our business. Whatever they generated here was reported separately, separate from continuing operations. Okay, now the less net income tax part, again, this revenue will be taxed, so this is the part that will disappear. What we're really keeping is just $21,000. Then for extraordinary flood loss, let's say that this actually happened in the business. We lost $20,000. This again also has a net tax effect, so we're really reducing this just $12,000. So overall, the net income after these two items is $63,000 altogether. This is different from 54 because we haven't considered these two parts of the income. Of income, regardless of continued, discontinued, we all consider the tax effect to it. So the 40% would always be paid to the state government, basically IRS. That's the part that company is not keeping. Okay. Any losses, $20,000, we also consider net tax effects. You can also think of this entire calculation as 90,000 minus plus the 35,000 that we gained from discontinued operations minus 20,000 times 40 is the total tax that we paid. And we separate them into three sections and consider their net tax effects. We're really overall looking like this. Okay, and then what the company is keeping would be 1 minus what's there. Basically what they're keeping is 60% of their earnings, right? Because tax is 40, so they're really keeping 60% of it. Now I start from 90 because earlier this example tells us that up to that point before tax is 90. Consider all before tax first and then times the tax rate. That would be the same as considering tax effects separately. Okay, so once again, this is the most complicated case. Sometimes companies do not encounter these situations, then the net income would just be $54,000. Okay, but if they do have these situations, we're a part of them, and we consider them first, and then we calculate the up-to-date net income. Now the reason why we're separating this discontinued part is because very likely next season's net income would be significantly dropping, for example, like around $20,000. Okay, because next season, if the company, this is the last season that they still have a hotel, assuming this is the hotel business that they own. Next season, they do not have this anymore. They decide to sell it to others. Then naturally, the net income, the income statement that you see next year will not be as high as this year. Okay, so this is giving creditors, investors, additional information that a sign for them, knowing that next year or the following years, very likely net income will not be $63,000 this much. Probably around $40,000 because they don't have this segment of business anymore. Okay, so this is really not because of net loss or any additional operation flaws, just because they have a major segment of business that's no longer there. That's why we want to separate it. Whenever you see this, that basically means this is the last year of this segment of the business in this corporation. That's why we separate it. last part to income